So why trade options? And so the question that'll come up, especially if you've got either a smaller account or maybe you just don't trade but you've heard of these names. But a question will come up, have you ever wanted to trade, like Amazon? And Amazon's this crazy stock that's like $3,200 a share, or Tesla, which went up to over $2,000 a share and then split 5 for 1, or Netflix, which is a $500, $400 stock. And what happens is that these stocks seem so expensive and so out of reach. A lot of people, they get, frankly, tricked into doing things like penny stocks, which I think is insane, or low-priced biotech stocks. Which again, for me, I know some people make money on it. I just look at that as Las Vegas. And so what's nice about this is that an option gives you um, on leverage 100 shares of stock to trade. Okay, so how does that work? And is that even worth doing? So one of the questions that'll come up is, as I'm talking about options, I always say, well, what about Bitcoin? What about the cryptos? So to be clear, I love the cryptos. And right now, Bitcoin's having a good move. It's up like 150% over the last year or something like that. It's, back up over 18K, and I like that a lot. Well, first of all, of course, that's I was talking about a $2,000 stock. That's an $18,000 stock, give or take. Of course, you can buy it fractionally. But the point here is that everybody gets excited about a 100% crypto move. But to me, Bitcoin is not a trading vehicle. I like crypto, but I'm a buy and hold. To me, crypto is like land. I'm going to buy Bitcoin, I'm going to buy Ethereum, and I'm just going to tuck it away and forget about it. I'm not going to trade in and out of it. But on the other hand, while everybody gets excited about moves in crypto that are, oh my gosh, it's up 100%, and sometimes you got to sit on it for months or years for that to happen, these kind of moves regularly happen, sometimes multiple times a week, definitely multiple times a month, in the options market. And what I'm talking about are options on stocks like Tesla, like Apple, like Netflix, no obscure stocks, all big household names. So one thing I actually like to do is I'll take the profits I make in options, the short-term profits I make in options, and put them in long-term portfolio of crypto, and that's the way to do it. So think of options as a way to create income, and for me personally, Bitcoin and the cryptos are not for trading, they're for holding. Okay, so that's kind of my take on both of those. But ultimately, I think if you're looking for short-term payoffs, I think options on stocks are way better, way more predictable, way more manageable than crypto. So why trade options? So here's a couple of examples of some trades. These all happened in less than a week. So here you can see I bought some call options on a stock called Beyond Meat. I bought some at $15.20, and I bought some at $3.68. About a week later, the $15.20 options were trading at $38.60, while the $3.68 options, 68-cent options, were trading at $12.24. These are gains of 153% and 232% respectively in less than 7 days. That should be in parentheses. So, again, crypto's exciting and I get it, but I actually think there's bigger and better and more powerful moves in options. And so I just wanted to show you an example of that. So one of the things that people really need to understand when they get into options is understanding, first of all, what is an option? All right, so let's say that Tesla is $800. All right, at one point it was $800, then it was $2,000, then it split 5 for 1, and now it's back to $500. But at one point it was at $800. So if you want to buy 100 shares of Tesla at 800 bucks, it's going to set you back $80,000, assuming you're not using margin. You could use, if you're day trading, you could use margin and things like that too. Or you could buy one option on 100 shares, and the price could vary, but on average it's about $2,500 depending on which option that you get. But the options that we like are slightly in the money. They're not the cheap out of the money ones, and I'll talk more about that. But the main thing here is you can see that you could buy one option for $2,500, or you could buy 100 shares of stock for $80,000. There's certainly a big difference here. And what the benefit is that one option contract is like trading 100 shares of stock. In fact, you can exchange it for 100 shares of stock if you wish. But the main point is for $2,500, you can participate in nearly the same movement of the stock as if you owned 100 shares. So the stock could go up $10, and your option, whereas it won't necessarily go up $10, but it could go up $7. Okay, so it'll go up a percentage of the underlying stock's move depending on what option you get. And so it's really a fantastic way to leverage on names that are real household names, not any speculative penny stocks or something that you have no idea what's going on. All right, and so it's a fantastic way to participate in the price movement of legitimate stocks using leverage. So the key differences between options and stocks. All options have an expiration date, okay, meaning they exist for a specific amount of time and then they're done. And at that point, when they're done, they're either converted into stock or they expire worthless. Okay, that option will disappear. All options have a strike price, which is the price at which it can be converted to stock. So if the strike price is $95, you can exercise the option to purchase the stock at a price of $95 a share. Now, if that sounds complicated, don't worry. I never do it. Okay, I think I've done it once. When I'm trading options, I buy the option, I sell the option, just like if it was a stock, just like if it was crypto, and I move on to the next one. However, if you want to convert it to stock, that is something that's possible. And again, one option contract will represent 100 shares of stock. So when you see an option priced at $1.25, it's actually going to cost you $125 because remember, it represents 100 shares of stock. So $1.25 times 100 shares equals $125. All right? And we'll dive into some more of this here. So how are options and stocks related? Okay? So you can also, we talked about buying an option. You can also sell short an option. All right, we're going to talk more about that later. What will happen in that case is that if somebody might say, hey, by the way, I want that stock, and you may be actually forced to give somebody 100 shares of stock. Now, that rarely happens, and when it does happen, it's not a big deal, but just to kind of give you an idea of the mechanics of how options work. So basically, when we're trading options, we don't exercise them, meaning we don't exchange them for stock. Okay, we're actually looking for things like, hey, let's buy these options at $3 and see if we can sell them for $6 5 to 7 days later. So we buy the option, we sell the option, and then we move on to the next setup. And that could happen in Apple. It could be in Netflix. It could be in Microsoft. It doesn't really matter what the stock is. In a nutshell, and to keep things very, very simple, if you think a stock is going to go up, what you're going to do is buy what's known as a call option. On the other hand, if you're getting nervous about something or it looks like something's going to go down, then what you can do is buy what's known as a put option. Okay, so if you buy a call option, it's a bet that the stock's going to go higher. If you buy a put option, it's a bet that the stock is going to go lower. What's nice about that is it doesn't really matter if the stock is going up or down. As long as you have a signal, you can take it both ways. And that applies for the market as a whole. If you see something that's on the horizon, it's like, man, I think the stock market is going to crash, you could buy a put option on the stock market itself. Okay, so it's a really fantastic way to kind of navigate and trade the price action without really having to take on a lot of risk. So we use a couple of different option platforms. There's a lot of them out there. I like Thinkorswim. There's Tastyworks, Fidelity, Schwab, you name it. So the platform we're going to be showing you here is called Thinkorswim, and they're really dialed into a detailed, kind of an advanced option platform, so you can kind of get a full picture of what's going on. So on this, at first glance, it's going to look like super complicated, like, oh my gosh, what is going on here? And I'm not sure what that drawing is. My art skills aren't great. But the idea here is you're going to say, like, okay, here's the stock square. All right, it's trading at about $83. And you can see here that there are different expiration dates. There's options that expire in 4 days. There's options that expire in 46 days. There's options that expire in 228 days, et cetera, et cetera. And there's different strikes. You could get a strike at $75. You could get a strike at $110, and they're all going to be priced differently based on the strike price. All right, and we'll talk more about that, but it really just has to do with, for call options, are the strike prices below the current price, which is in the money, or are they above the current price, which is out of the money? Out of the monies are cheaper because that represents an area where the stock might go, but isn't necessarily going to get there, and certainly isn't there right now. It's kind of a sucker's mitt, to be frank, so we don't do a lot of those. Now, after you pick a direction, say, oh wow, I think this stock or this market is going to go higher, or I think it's going to go lower, and so you choose a direction, then you want to figure out what is going to be your strike price and the expiration date. All right, and there's a nice simple formula for this. First of all, for the strike price, the price of the stock, we're going to be looking here at the price of the stock. So if the price of the stock is $100, okay, that means we could get an option at $100. We could get an option at $90. We could get an option at $110. So we want to pick out what's the option that's going to give us the highest probability of success, right? And from there, we want to pick an expiration date. And really what that means is how long are we going to give this option an opportunity to work out. So a mistake a lot of people make is they may, it's Wednesday, I'm going to choose an option that expires on Friday. So they're only giving their idea 2 days to work out. So if they're not right over the next 2 days, they could lose all their money. So oftentimes, if you give it more time to work out, you will have a better chance of success. All right. So specifically, how do we do that? So let's say that you think Apple will move above $390 in the next couple of weeks. Okay. So you buy an Apple call option at $390. If Apple moves above $390 before your option expires, your option gains value. Now, if you had bought an Apple $420 call, okay, which is, so here's the stock right here, and then here's the $420 call. Basically, if by expiration the stock can't even make it there, your option's going to go to zero. Okay, so even though these out of the money options are attractive because they're cheap for a reason. It's very, very low probability that it's even going to get there. Okay, so we want to be very careful that we're not buying the wrong option, and that's what I made a big mistake of when I first started. Okay, so strike price is really important when you're choosing which option to do. Don't just go for the cheapest one. The cheapest one is typically the worst one. So from there, when you look at an options chain, it's pretty easy to get overwhelmed, but if you just take a deep breath, of all the stuff that we're looking at here, we're just going to narrow it down to a handful of things. So as we look at this, we're going to see that there's different options for different dates, okay? And there's different options for each strike price. And so what we want to do is just kind of narrow down and have a small kind of a checklist on, okay, if we've got an idea that something's going to go higher, what do we do? What is the high probability trade? Okay, so first let's take a quick look at some basic terminology. So an in-the-money call option is essentially the stock price is above the price of the option. Okay, that's just called in the money. As an example, if Tesla is $850 and you buy the $800 strike, you are buying an in-the-money option. An at-the-money call option is that the stock price and the strike price of the option are about the same. As an example on that, if Tesla is $800 and you bought the $800 call, that's an at-the-money call. Okay? And then last but not least, we have the out-of-the-money call. And in this case, the stock price is well below the strike price of the option. In this example, let's say that Tesla is trading at $750 and you opt to buy the $800 call. That's the out of the money call. In general, I am not in favor of doing that simply because the odds are stacked against you in many, many ways for that to work consistently. Yes, it can work once in a while, typically about 10 to 20% of the time, but I'm more interested in trades that work, 80% of the time. Now, what about for puts? For puts, it's the same thing, but it's slightly reversed since in this case we're making a bet that something's going to go down. So in this case, an in-the-money put option is going to be something where the stock price is below the strike of the option. Okay, so if Amazon's at 1900 and we're betting that it's going to go down and we want to get something that's in the money, we got to get something that's above that price. So in this case, the $2,000 strike is in the money. At the money, that's easy, it's the same. So if Amazon's at 2000 and we buy the $2,000 put, at the money, okay? And then out of the money is exactly like the calls except flipped, and let's assume that Amazon is at $2,200. So an out of the money call would be at $2,400, right? It would be above it, but the out of the money put is below it. So in this case, the $2,000 strike would be out of the money because it's far below, meaning that Amazon would have to fall $200 just to start getting interesting, okay? Which it certainly could do, but the odds of it happening are lower. So in the money, out of the money, at the money options. All right, and if you look at this visually, you'll see very quickly that it all kind of comes together because Apple is at $390. So you can see at a glance, here's the at the money calls and puts. The in the money calls are going to be this way, and then the in the money puts are going to be this way. And in general, I am not interested in the out of the money calls, and I am not interested in the out of the money puts for directional trades. Okay? Now, we're going to get more into this later, but my rule is to buy in the money options. So I would rather spend more money to get in the money options. And part of this discussion will discuss how and why we do that. Okay, and it's a good question. Jason's just asking, like, how do you determine if the option is too expensive? So first of all, just using a quick example, let's say Square, it's $80, okay, and the in the money call, the $70 strike and the $90 strike, the $70 strike might be $12, but the $90 strike might be $2. And so if you glance at this, you're going to say, wow, this one seems a lot cheaper, okay? Or let's say it's $3. And you're going to look at this and say, well, this one seems cheap and this one is expensive. But the reality of it is that the premium portion of this option, is $2, and then the premium portion of this one is $3. And it's really the premium is what that'll make or break you. So in this case, yes, the option is higher priced, but it's fair because $10 of that is what's called real value. And I've got some slides on that, so we'll cover that in more detail. But the main question there, or the main answer I wanted to give, is that just because something is higher priced doesn't make it expensive, and that's a tricky thing to kind of understand. There are some things like implied volatility and a few things like that could kind of rule it out, but don't look at something and say, oh wow, this is lower price than this one, it must be a bargain. It absolutely is not a bargain. So the reason I like these more expensive options, okay, is that they're less risky because they have more value to begin with, and more importantly, they gain value faster as the stock moves in your favor. Okay, so the idea is that we want to buy an in the money option. So an in the money call simply means a call option that is below the current price. Okay, so if Tesla is at $850, we buy the $800 call, and then an in the money put is it's above the price because we're looking for it to fall. So if Amazon's at $1,900, we want to buy the $2,000 strike. And again, these are just very generic examples, but I want to kind of get the idea of in the money.
All right, so call options. How to trade call options. So for call options, if you think a stock is going to go up, we're going to buy a call. Awesome. What call do we want to buy? So let's talk about Square. Square is a nice payment app. It's got a good trend. It's in the news, and we think it's going to go up. So to participate in the move up, we want to buy a call option, but we want to buy the right call option. If we buy the wrong call option, we could be right in that Square goes up, but we could still lose money. Okay? Okay, so what we're going to do is we're going to buy a call, and we're looking for a high probability setup here. We're going to select a strike price, and we want to get something that's below the current price. All right, so we're at $83, and we are going to come down here and look at some strikes that are below that. Now, the other thing that we haven't talked about is the expiration date. Okay, now we just talked about, hey, it's fun to buy things that might expire in 4 days or 0 to 1 days, and I totally get that. For consistency, though, if we're looking for a stock that may say move $5 over the next week or two based on a signal, I like to go further out. Believe it or not, even if I'm only planning on being in the trade 5 days, I would much prefer buying an option 30 to 45 days out than I would buying something 5 to 7 days out. And the reason for that, and we'll talk more about it, is the premium decay. If you go out further out, your premium decay is really slow and it's really forgiving. If you do it closer in and it doesn't move, you just die by the premium decay. There's a way to take advantage of that. But for now, I want to keep it simple, and we're focusing on buying that call. And we want to buy the call that's going to give us the best opportunity for success. So which ones do we get? So what I like to do, there's a concept called delta. Now, believe it or not, if you guys have heard of the Greeks, they're useful, but you don't really need to fully understand them. Believe me, if you learn them, it helps, but for the simple setups that I'm going to be talking about, you don't need to worry about it. Delta simply tells you how much the price of the option moves when the stock moves. Okay? So that's kind of useful, right? So in other words, what you're really going to find out here is that those cheap options don't move very much. So if we get a delta of 1, now basically a delta of 1 is an option that's really, really deep in the money, but really it's the stock. A stock has a delta of 1. So a delta of 70 simply means that if the stock moves up $1, in this case, your option's going to move up 70 cents. So that's not too bad. That's a pretty good use of leverage. However, if you buy a cheap out of the money call, okay, in this case 20 cents, it means that if the stock moves up $1, your option's only going to move up 20 cents. And this is where a lot of people get caught up, where it's like, oh my gosh, I'm killing it. My stock moved up $5 today, and your options may have moved up $1, which isn't bad, okay, but that's not the same as if you had a delta 70. And if it doesn't keep moving up, this could go away very, very quickly. So you want your option to move more when the stock moves. So a higher delta is ideal. My rule is to look at the delta 70 options. They'll be more expensive, okay, but by expensive, I don't mean overpriced. They're just higher priced than the out of the money options because they're quality, okay? They've got some intrinsic value. All right, so what does that all mean? First of all, why not buy cheaper options? Well, when you buy that cheaper option, it's out of the money, you are buying 100% premium. Premium is just the extra cost that you pay for an option beyond the quantifiable value of the option. Okay, that sounds confusing, right? It sounds like a mouthful. But in other words, cheap out of the money options actually have no value. They are worth nothing until they go in the money. You're basically paying like like if you're trying to get into a nightclub, you're paying a cover fee just to get into the club. You don't get anything except you get into the club. And if you're buying an out of the money option, it's like you're paying a cover fee. You're never going to get that back unless that stock really races and explodes above and beyond any move that's currently planned out by the market makers. So there are times, of course, when out of the money options can pay off, but it is extremely rare. So to view the delta, if you are using Thinkorswim, but this does in most programs, you can typically look it up and put delta on, and then you'll see a column for delta. And then you'll sit there and say, okay, here's delta 62, here's 68, here's 74, and then you can see these delta 10s, they're super cheap. It's not super critical. You don't have to exactly get delta 70, but you want to be in the ballpark. As a rule of thumb, if you don't have delta, okay, the rule of thumb is just go 2 strikes in the money. And what I mean by that is if you're at $83 for the stock price, go to kind of where that is, so 82.50, go down 1 strike, 2 strike, there's the 77.50, it's a delta 68, and that's close enough. The main thing here is what you want to avoid is getting lured into these cheap options up here, which are, basically going to expire worthless 9 times out of 10. Okay? So that's the main point there. The next question is once you choose which option strike, you want to choose what the right expiration date. And the reason for this is you want to give yourself enough time to allow the trade to work. Because if you don't give yourself enough time, you could be right, but the option expires before the move could even happen. So options further out in time are going to be a little bit more expensive, but these options literally buy you time for the trade to work out. Okay, and of course I'm talking about specifically directional trades where it's like, okay, Microsoft, I'm looking for it to go up $5 to $8. How much time am I willing to give my Delta 70 call to work out and do its thing? So my general rule for buying options is give yourself the gift of time. Yes, it's attractive to look at those options that expire in 2 to 3 days, but if you give yourself 10 days, 20 days, 30 days, you're going to put your odds so much more in your favor, even if you're only planning on holding the trade for a couple days. Okay? All right. So one last Greek term to look at is theta. Now, theta sounds like a fancy word, and it is a fancy word, but just think of it as time. Options expire. So, over time, the premium portion of the option decays and goes to 0. This is known as theta decay. Theta decay, think of theta decay as, if you go to the car lot, you buy a brand new car, the moment you drive it off the lot, you just lost $5,000. Okay? A used car does not sell for the same price as a brand new car. That's theta decay. And the longer you drive that new car, the lower that price is going to be when you go to trade it in. Okay? And it's the same thing with an option. Theta decay speeds up as the option gets closer to expiration, so it's best to give yourself time for the trade to work out before that decay really starts to accelerate. That's kind of when things can really get hairy if they aren't working out well. So here's a way to picture this. So let's say that the square is at $80 and you buy the $75 call for $10. The way to look at that is that half of the price of that option is intrinsic value, which is real value, okay? And you determine that by taking the stock price, $80, less the strike price, $75. Remember, that $75 call gives you the right to own the stock at $75. Since it's currently at $80, that's an immediate $5 profit, because you could turn around and sell it for $80. So that $10 price, $5 of it is real. The other $5 of it is just premium. It's the price of admission to play the leveraged instrument. And this portion of it will decay to 0 by the time you get to expiration. So if you think of it this way, if on the day of expiration Square is still at $80, you'll still have the real value here, which is $5 because it's the $75 strike, but all of this will go to zero. Okay? So on something like that, you can see that by the time you get to expiration, if the premium portion of the option is zero, you got to think through the implications of what that means. It also means, and a lot of people, and I didn't realize this for a while, is that the price movement of the stock has to overtake the premium decay. Okay, and it simply means that the stock can't really dawdle along and kind of move higher if you're going to make money. It actually has a need to have a pretty good move, a pretty good accelerated move. If you guys have seen Tesla this year, Tesla has had some amazing moves up, and out of the money options actually worked on Tesla. That's rare, but it's fantastic when you can catch a move like that. Here's another way to look at this. So if we're looking at all the strikes, and again, since we're talking about Square, let's keep talking about that. And let's say here's $80, and then here is all of the out of the money options. So we're talking $90, $100, $120, $150, and here's the in the money options, $75, $70, $50, etc. By the time you get to expiration, all of this will be gone. All of that will be at zero. Okay, so any out of the money options will go to zero and expire worthless, and any in the money options, the premium portion of that price will also go to zero, and all that's going to be left is this. So if you think about this, you're only really playing for the slice of real value, and the premium is the price of admission to play that slice of real value. So if you're playing around here, it's just such a ripoff, to be frank. I mean, those options are designed to suck people in and expire worthless. That's why they're so cheap, and you just want to be really, really aware of that. So what about how fast does the premium decay? All right, so look at this. So let's say the option's 60 days out. Okay, if you own an option that starts off at 60 days out and you hold on to till it's 30 days out, your rate of premium decay is like this. So yes, you're losing some premium, but it's not a lot. This, if I'm eyeballing this, it looks like maybe 25% of the premium over 30 days has eroded. Okay, so your stock, if it's gone up even a little bit, can certainly offset that, and if it goes up quite a bit, it'll offset that easily. But look at the next 30 days. Okay, so you've got a situation, and this should be 15 days, but if you got a situation here where it starts to accelerate, and then the last 15 days it falls off a cliff. So as a rule of thumb, I really like to, if I am going to buy an option, I really like to give it 30 days or more. And even if I'm going to hold it for like 5 days, because the rate of decay is so slow. If I'm buying something here, I'm really fighting like lemmings over a cliff, and it's very, very difficult to overcome that. All right, so hopefully that makes sense. And the main thing here is that we just want to go in the money, and let's go over 30 days, and that's going to give us the best opportunity for success when buying a call, or frankly, when buying a put. Okay, so if I have a setup off of a daily chart, and a little bit later we'll talk about specific setups, 30 days is the minimum, but even 45 days or a little bit more is fine. Okay, the more time you give yourself, even if you're only planning to hold the trade for 5 to 10 days, you're increasing your odds of success because you're not having to fight that losing battle against rapid premium decay. Now, if I'm trading off an intraday chart, like say a 2-hour chart or a 4-hour chart, okay, I can go under 30 days. Let's call it 15 days to 30 days, simply because that's a trade I'm only going to be in for 2 to 4 days. Now, could you go further out? If I could spell right. Could you go further out? Absolutely yes. So if you're looking at this and thinking, you know what, I want to go 6 to 8 weeks, absolutely yes, but never the other way. If you've got a daily signal and you're like, you know what, I think I'm going to do next week, you're really playing with fire there. Okay, so when in doubt, you can always go further out, but It doesn't work the other way. Don't succumb to the temptation to say, well, I got this daily signal. I bet it's going to work out in 2 days, so I'm going to buy an option that expires in 2 days. It's just one of the worst habits you could ever develop. Now, if you're trading off a smaller time frame, like a 30-minute chart, which typically is a trade you're only going to be in for 1 to 2 days, then yeah, if today's Wednesday, I could buy something for next week's expiration, that's fine. But in general, I'm not going to buy something with 2 or 3 days to expiration. I'll sell those options, and that's another slide that we'll get to, but I'm generally 9 times out of 10, more like 19 times out of 20, unless it's a special case, Tesla being a good example of that, I'm going to avoid it. And frankly, that's really more if you got a little bit of experience with that. Okay? When in doubt, give yourself the gift of time. It will save you so much heartache. All right, so if we're buying a call and we want to finalize the price, so once you select the option you want to buy, you're going to see the order entry, and you're going to right-click $9.35 and confirm and send. My other rule of thumb here is never do a market order, okay, for entries. Sometimes you might have to for exits if you're trying to get out, but never do a market order for entries. When you do that, it's like going to the used car lot and saying, hey, I really like that green BMW. Here's a blank check. Please fill in the price that you feel is appropriate. Okay, what do you think the used car salesman's going to do? He's going to jack up the price and rip you off. It's kind of the same thing in the options market. If you do a market order to get in, you're going to get the worst fill possible. Okay, so do a limit order, typically in between the bid and the ask. If you have Thinkorswim, you can use what's called the midpoint, and that's a pretty good area to get in. And yeah, and there's the mid price right there, as detailed on that slide. So for a review on this, what you'll see and what you'll see up here to review is you're going to see something that's kind of weird. It says buy, +1 SQ100 17 July 20. I mean, it looks like, what is all this? So really what you're looking for is, this is the action. You're going to buy something. Okay, it's going to be on Square. This just means that one option is 100 contracts. Okay, it's like, I don't know why they did that, because they brought out some minis, which nobody really trades anyway. This is telling you that when it expires and there's a strike, is it a call or a put, and what's the price? And then are you opening it, meaning that you're entering the trade, or are you closing it, meaning you're getting out? And that's how all that works. Okay, so that's it. Let's wrap up buying calls, and then we'll jump into puts, and then we'll jump into verticals. So pick a stock that you think is going up, select the expiration date, and give yourself time. When in doubt, give yourself even more time. If you're looking at a daily chart, buy options that expire in 6 to 8 weeks. Resist the temptation to get those cheaper options that expire in 2 days. Select the strike price you want, finalize the price. You can click the lock button to make sure that the price doesn't change. Double check your max loss and max gain. Confirm and send your order, and you'll get an alert once the order is filled. Let me back up here real quick. One thing here is that you do want to kind of get an idea of what is your max loss. The nice thing is when you do buy a call option, so in this case, one at $9, the absolute most you're going to lose is the amount of money you pay. Okay, so this isn't like futures where you put up $900 to control some futures, and it gaps way far against you, and suddenly you owe the broker $1,300. That won't happen in this situation. The absolute most you're going to lose when buying a long call or a long put is the amount you pay for the option. Okay, and so that makes it kind of easy, and it also helps you kind of figure out like exactly how much risk you would like to take. Okay, so if you think a stock is going to go down, we can look at buying a put option. So we're going to look at Square again, and let's say, you know what? Yeah, it's been going up, but I think now it's too extended or whatever, and it's going to come down. It's an $80 stock. We want to buy a put, and what put option do we buy to maximize our opportunities for success. To buy the put, we're going to select our strike price, and this is the price in the middle. It represents the price of the stock. We're going to select the expiration date. You can see right here. And here's the strikes right in the middle. We're going to figure out our expiration date. Remember, we want to give ourselves the gift of time, so we're not going to be looking at 4 days out. We're going to be looking over here. And then number 3, we're going to check the price. And to get it, we just click on the Ask column, and that will set us up to buy that put at that strike price. Not surprisingly, we're going to use delta to choose which put option to buy. Just like with the calls, if we are buying a delta 70 put, which is in the money, that means if the stock drops $1, our put's going to gain 70 cents in value. Pretty sweet, right? If the stock plunges $10, our options are going to gain $7 in value. Okay, fantastic. If we go far out of the money and buy a delta 20 and our stock moves $1, we're going to make a paltry 20 cents. Okay? Now don't get me wrong, there's some times when you buy out of the money puts and it works extremely well. As we all know, or maybe you don't know, but markets move down a lot faster than they go up. If you remember March, you could have bought out of the money puts then and made a lot of money. But again, it doesn't happen all the time. You'll want your option to move more when the stock moves, so the higher delta is ideal. And just like with calls, my standard rule is when in doubt, buy the delta 70 options. Yes, they're going to be higher priced than the delta 20s, but as we know now, there's a reason for that. They're going to gain more faster. You don't have as much premium decay to deal with. It puts the odds in your favor. All right, so if you want to figure out the deltas, you do the same thing. You tee up the deltas, and then you'll notice the deltas on this side are negative, and the deltas on this side are positive. For our purposes, that doesn't mean anything except that this is just designating that it's a down move. So we'll look at this and say, oh, wow, look at a delta 76, a delta 65. That's the ballpark we want to be in. And if you do have a platform that doesn't have delta, and I think most of them have delta these days, but if it doesn't, do the same rule of thumb and just go 2 strikes in the money. Okay, so if we're at 83 bucks, and remember in the money this time is this way, then we're going to say, okay, great, let's look at the 85s, let's look at the 87.50s, bada boom, bada bing, you're right in the zone. Okay. And you know, sometimes the question I'll get is like, well, should I get the 68 or the 72? Honestly, it doesn't matter. If it's up to me, I err on the side of going with the slightly higher delta. But between 0.68, 0.72, it's not the end of the world. The main thing is you're not getting the delta 20. So you're not doing what all the noobs are doing. Okay, you're doing what an experienced trader is doing, and you're going in the money. All right, while we're talking about which options to choose, let's now again visit the expiration date. Options further out in time are going to be more expensive, but again, you're buying that time to give your trade a chance to work out. And just like calls, my general rule is give yourself the gift of time. All right. Theta, same thing. We've covered this already, so I'm not going to go in this in depth, but theta decay works the same with put options when you're buying a put as when you're buying a call. Okay. Remember, the closer it gets to expiration, that premium is going to fall off of a cliff. That's why we want to give ourselves the gift of time. You know, it's a good question on the VIX SPY strategy. That was something that worked for a while. I would say right now that the VIX SPY strategy is a little broken. I think it's going to go back to normal next year. I think we need to get that VIX back in that under 20 range, where you're going to get those spike ups in volatility, you know, when the market drops. But yeah, it's been an unusual year, to say the least. Okay, so same thing here. My guidelines for puts are exactly the same. If it's off of a daily chart, let's give it 6 to 8 weeks. If it's a 2-hour or a 4-hour chart, or even an hourly chart, let's give it 3 to 4 weeks. And if you're trading the 30-minute chart, okay, let's go to next week. So the same guidelines for buying a put as buying a call. Yeah, Kim, on Tesla, I really like Tesla here. I don't have it. This is one of the, usually when there's big moves, I'm all over it. I've been kind of taking a little bit of a pause the last couple of weeks. But I would be looking, if there's any weakness in the morning tomorrow, to buy some Delta 70 calls and seeing if we can break through to new all-time highs. And then same thing for buying a put, finalizing the price. You tee it up. You can lock it here so that it doesn't change, because what will happen is this actually fluctuates as the price changes. So if you want to lock in your price, you can click that. Sometimes I forget. It's not the end of the world, but if it's moving really fast, it can change quite a bit. So if you've got a specific price that you want, hit lock and then confirm and send. And then again, the same thing. You're going to get this weird thing that says buy, +1 SQ100, blah 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 blah. And just remember, that's just telling you what you're doing. You're going to buy something. Okay, that's your action word. You're not selling something. It's on Square. It's the normal contract, which represents 100 shares. Here's the expiration date. That's the strike. This time you're getting a put, not a call. That's your price, and it's to open. And after a while, it'll make sense. But at first, when you do it, it looks kind of weird, because there's when you're buying a stock, it's like, oh, you're buying Tesla. When you're buying Bitcoin, it's like, oh, you're buying Bitcoin. And this just initially looks weird, right? But once you understand kind of what it's saying, it just gives you an opportunity to double check your work and what you're doing. Okay? So my recap here is exactly the same for calls, just in reverse. Give yourself the gift of time. Get the strike price that you want. Once you get that price, lock it in, and then confirm and send your order, and you are good to go. And so the question will come up is, okay, well, if they expire worthless, well, could we sell the options? And I remember the first time I had this aha moment, because I would buy options that would frequently go to zero, and someone, a trader friend of mine, said, yeah, I probably sold that one to you. And I said, what? He's like, oh yeah, no, I was selling those calls, and I got to keep the money. So the money that you lost actually just went to my account. And that really knocked me upside the head, because I just thought if I bought a call and I lost money, that money was just gone. It wasn't gone. It was being lassoed into my friend's account or into other traders' account. And I was like, oh my God, so you mean all the times that the options I had go to zero, someone was making money off of me? And they're like, yeah, you didn't know that? And I was like, no, I did not know that. So I was like, okay, that kind of opened up a whole new world. So think of it this way. Here's a stock at $100, okay? If I think it's going to go up and the $100 call is at $5, and the $100 put is at $5, okay? And if this goes up to, 110, yeah, your call is going to gain value, but the put's going to go to zero. If you sell the put to somebody else and it goes to zero, you get to keep it. If you sold one put at $5, that's $500. If it goes to zero, that $500 stays in your account. Or let's say that it drops to $1. If you buy it back at $1, then you keep the $5 minus $1. You keep the $400 in your account. It's like, oh, wow. So all of a sudden this got pretty interesting, because even though theta decay is your enemy when you're long an option, it's actually your best friend when you're selling it to someone else. Okay? So the question then I'll often get, and I want to save you guys a lot of heartache here, is that if I think a stock is going to go up, can I sell a put option to someone else and just keep the money while the stock goes up and the option expires worthless? Or if I think a stock is going to go down, can I sell a call option to someone else and just keep the money while the stock goes down and the call expires worthless? And my answer is yes, but. Yes, but. Okay, so what's the but? Selling naked options is too much unnecessary risk. Okay? Now, if you do sell options, I will say that there are times when selling naked puts is a good idea, especially if you're trying to acquire the stock at a cheaper price, meaning you want the stock to fall and you want to get assigned. All right? That's above and beyond what we're talking about here. And what I'm talking about here is making a consistent living trading options and doing it in a way that creates consistency and avoids the heartache of the huge loss. Okay, so what can happen by selling naked options? Well, Selling naked options, especially calls, can open us up to some really horrible, horrible situations. For example, let's say that it's Thursday and I'm selling calls on Netflix that expire the next day on Friday, and I'm selling them out of the money for $1. And then Netflix gets upgraded, okay? And the stock's up $50. Well, that option that I sold for $1, and again, this is just ballpark math, is now $50. What does that mean? I sold that for $100 hoping I was going to get $100 in income. Okay, let's say I sold one. And then I got to buy it back at $50. Okay, $50 minus $1 is $49. That means I lost $4,900. Let's say you did that with 10 contracts, so you're hoping to make $1,000. Guess what? You just lost $49,000. Let's say that you did it with 100 contracts, hoping you're going to make $10,000. Guess what? You just lost $490,000. No thanks. I never had anything happen to me that bad, but I have been on the bad side of naked options, and I have met people who sold naked options and they lost their business, they lost their wives, their kids no longer talk to them. I mean, it's brutal, okay? So I'm just saying, although selling naked options sounds attractive, don't do it. And when I show you some specific examples, you'll understand why you don't need to do it, okay? You don't need to do it because you can make the same amount of money by doing spreads. Okay, so don't sell naked, but still sell options. Selling options is amazing. So it's best to avoid the risk of selling options naked, especially since there is no need to subject yourself to that much potential pain and suffering. There is this weird thing in trading, and I'm going to go off on a slight tangent here, is that if you do carry a lot of repressed trauma, and that's different for everybody, and you have not released it, and you're unaware of that, it can work itself out in the financial markets by causing you to unintentionally do things that will trigger massive pain so that you can actually experience and relive it. I know that sounds crazy, and I'm not going to go into that too much. You're just gonna have to trust me on that based on my own personal experience with the markets. The way to avoid that is to not open yourself up to unimaginable pain and suffering in trading. And the way you do that is with spreads, okay? And a spread is basically a naked option with a fixed stop loss. And that's what we want. We want a setup where no matter what happens, we know exactly yeah, only go naked in the shower. We'll know exactly how much we're at risk, okay? If you're naked, you actually don't know what your risk is because you could have some crazy situation like that. All right, so for selling options, we use what are called vertical spreads. A vertical spread allows you to sell a call or a put and collect a credit for the trade, but be protected, okay? So you can benefit from the option losing premium and expiring worthless, or losing premium and just falling in price and buying it back at a cheaper price. You get to keep that difference. So what you do in a situation like this is that if you say like, okay, Netflix is at 400 and I think it's going to fall, and so I'm going to sell the 410 call at $1.50. And it's great because I'll get to keep that. Well, instead of just selling that naked, you sell the 410 call, but then you buy like the 415 call for whatever it is, 75 cents, and you're not going to get a credit of $1.50. You're going to get a credit of $1.50 less 75 cents. So you have a smaller credit, but you're safe, okay? And guess what? If you want the same amount of potential premium, just double the contract size in this case. That's why it's so ridiculous to sell naked, because you could just increase the amount of contracts on the spread, pay a little bit extra in commission, and you can get the same potential profit. Okay, that's why selling naked is so insane, especially with all the commission wars going on right now. Commissions are cheap. It's not like 5 years ago where it was like, okay, it's $100 a leg and $5 a contract. It's cheap now. No reason to go naked. All right, So for a put vertical spread, if you imagine you've got a stock hanging out here, and it's like, okay, we're going back and forth here. I think what I'm going to do is when it comes down to support, I'm going to sell that at the money put, but instead of doing it naked, I'm going to buy a put below it so that if in case the SEC comes out and investigates it and it drops $100, my risk is fixed to this. So the beauty of this, if it falls $100 and you are only willing to risk $200, you're only going to lose $200. Okay, so that's the beauty of it. If you were naked, you would lose the entire $10,000 a contract in that case. So that's the beauty of this. In this case, if the stock goes up, you make money. If the stock goes sideways, you make money. All that has to happen is it just kind of stays above 115. And you get premium decay in your pocket every day, okay, which is kind of fantastic. From there, here's an example. So if you're looking at your platform, here is Netflix, and you think it's going to go down, so I'm going to sell the lower the you can see here you got the options here. So I'm going to sell the put. I'm going to buy the lower priced strike. So I can sell the 500 and I'm going to buy the 495. So I'm not naked. And then what's going to happen is when you set this up, you'll see a price. Typically, if it's a $5 wide, meaning that in this case I'm like, okay, I'm selling the 500 and I'm going to buy the 495 for protection. You're selling it. It's going to be for within this range, right? So if you can sell it for about half the width of the, it's a pretty good deal. And then you're risking, in this case, on a 2-contract trade, you're risking $490 to make $510. All right, and of course, if you want to do 10 contracts, then it's $2,500, etc., etc. So I don't know if you guys can see this. I know that it's a little small, but what this is, it just shows a put credit spread on Tesla. I did 4 contracts. I sold it at 520. Here you can see it's trading at $1.35, and so my profit on this is $1,550. That's real money, right? $1,000, $1,500. So what happens is you sell it, in this case, at 520. As it drops in price, that's to your favor. It's like you're shorting a stock. If you short it at 100 and buy it back at 80, you keep the $20. It's the same thing with options. It's like you're shorting the option, so you want to buy it back at a cheaper price, and the difference is your profit. And in this case, you don't have to let it go to zero, and my advice is don't try to let it go to zero. If you sell it at $2, buy it back at 80% of max profit, which is 40 cents. And so all you got to do with that is here's your credit, $2 times 0.20. That gives you 40 cents. That's your target. The nice thing is you're not really trying to figure out where's the stock going to go, because it could trade sideways, it could go higher, it doesn't matter. As soon as you place your trade on, place a good till cancel order to get out at that 80% of max profit. Okay. So the put credit spread, you are going to sell a put, and then you're going to buy a put below that for your protection. That's going to define your risk. And then all you want is the stock to stay above that price. Now, it could dip below for a couple days. That's fine, especially if it's in an uptrend. And then if it comes back up, you're good to go. The nice thing is if it dips below, yeah, you're going to be down a little bit, but not that much because your risk is fixed. You don't have an unlimited risk situation. So that's pretty nice about it. And then your max loss is the difference between the 2 strikes minus the credit you put in. So if you have a $5 wide strike and you sell the premium at $2, then 5 minus 2 is $3. So if you did one lot here, you could potentially make $200, and if it just doesn't work out at all and goes way against you, you'd lose $300. But the nice thing is the probability of success is much higher than a long call because the premium decay is in your favor. So put credit spreads are less sexy, but they're higher probability of success. And I kind of like that. And you could always trade bigger put credit spreads than you do long calls, and you kind of could make the same amount anyway. All right, let's talk about the opposite strategy, which is the call credit spread, meaning that in this case, you think the stock's going to trade sideways to lower. So you sell the call. So, I guess one thing I haven't talked about is there are a lot of books that talk about it's called a 1 standard deviation and 2 standard deviation. I actually like to sell calls and sell puts at the money. Remember, we were talking about the at the money earlier. A lot of books recommend you actually sell calls like, say, 1 standard deviation away or 2 standard deviations away. Here's why I'm not a huge fan of that. 2 standard deviations away is attractive because it has a 94% success rate. What I don't like about it is you're risking 20 to make one. Okay, so what that means is you could have 19 trades in a row that make money. Number 20 doesn't work, it gaps against you, and you just lost all the profits you made on those 19 trades. If you go at the money, what you're dealing with is more 1-to-1 risk-reward ratio. Okay, so if you've got a setup with a high probability of success and you're dealing with a 1-to-1 risk-reward ratio, over time your consistency in your equity curve is going to be a lot better than, oh my gosh, I'm winning 94% of the time, and then you get the big puke. 1 standard deviation is better. You win mathematically about 68% of the time, but you're still risking about 10 to make one. I actually am not against these. I like them, but at the beginning, I actually encourage more at the money, just because you're not going to get into a situation where it's like, okay, I'm trying to make $100. Why am I down $1,000? Okay, because it's not fun. So that's why I do them at the money. The key, though, is to have a setup that you believe in, and so we're going to talk about a setup here shortly. Okay, so let's look at a call. So same thing here. It's just the opposite, right? So we're selling, in this case, the $500 call, and we're buying the 505 for protection. Remember, if it was a put credit spread, we'd be selling the $500 put and then going underneath it the 495 for protection. And in this case, you can see here your risk to reward, and you always want to get a handle on that. Now, here's an example of a call credit spread where I thought, you know what? I think Netflix is going to go down, but instead of buying a put, I'm going to sell the 320 call. I'm going to buy the 325 call for protection. I sold it for $1.56. Here it's worth 11 cents. The difference is mine to keep, $1,450. Okay, so selling premium is a legit way to bring home the bacon, bring in that extra cash flow, and I'm not taking a lot of risk. These are not naked calls, right? They're risk defined. Okay, so let's look real quick. I got 3 quick slides I want to show you, because the argument I will get, or the pushback I will get, is, gosh, John, if I would sell the naked call, I could make a lot more money. Okay, it's like, well, what do you mean by that? Well, let's look at Shopify. If I sold one at the money 920 call, which is about where it was today, I could, for $45, I could make $4,500. Okay, so again, one naked call at the money, I could make $4,500. Now, if I do that's a one lot, right? If I did a one lot spread, my potential profit plummets from $4,500 all the way to $250. This is the pushback I get. John, I'm not doing this to make $250. I'm like, I understand that. But if you look at the risk you're taking to make that $4,500, the amount of risk you're taking is theoretically infinite. Now, I've not seen a stock go to infinity, but I've seen plenty of stocks explode, and you could sell that at 45 and end up buying it back at 200 and get annihilated. Okay? So what's the answer? I want to sell. If you see something like this and you're like, man, I really want to try to make that $4,500 selling that one fat and juicy at the money call for $45, but it seems like I'm limited as a spread, guess what? All you do is up the number of spreads until you could get the same $4,500 credit. So in this case, all you got to do is up it to 18 spreads, 18 contracts. So 18 contracts, okay, where I'm doing the $5 wide spread, gives me a $4,500 credit with a max loss of $4,500. More importantly, the buying power effect is only $4,500, whereas the buying power effect on the naked option was a whopping $17,000. That was on one option. If I was trying to do 18 options, that would be $17,000 times 18. All right, so by doing it as a spread, you get the same amount of potential profit. You're simply doing 18 contracts in this case instead of one. The amount of buying power is way less, and you are not in a situation where you're going to experience a devastating loss. The only thing that's going to cost you a little bit more is in commissions. And in these days, the cost of commissions is so low, it's a real cost. Compared to the risk, it's negligible. Okay? Okay, so hopefully that makes sense. So don't get caught up in the allure of, oh God, I'm going to sell this naked. I can make so much money. All you got to do is just sell more credit spreads until you get the same amount of credit you would have gotten anyway. It's so much safer. It's much easier to manage. And guess what? All it's going to cost you is a little bit extra in commissions. And these days, commissions are dirt cheap. One other little trick here. This was a thing that I fought, is that I would sit there and say, okay, I'm buying a call option. The stock's at 90. I think it's going to go to 100. And I'm buying a call option, at 5. And if it goes to 100, it'll be at 10. And I'm going to buy 10. I'm going to make $5,000. And I would sit there and say, well, gosh, if I sell 10 put credit spreads, I'm only going to make $1,000. Why would anybody want to sell put credit spreads? Guess what? Typically, if you're going to buy 10 calls, you could sell like 30 put credit spreads and get the same potential $5,000 profit. But guess what? Instead of the stock having to go all the way to 100, all it has to do is it could go sideways. You could be wrong and still make money. Okay? So once you start to learn things like that, it's like, oh man, buying a call doesn't really make a lot of sense. Now, do I buy calls? Absolutely. But it's got to be a special situation, like, wow, Tesla, high short interest, all that kind of fun stuff. I'm going to buy calls. But when I sit there and I start looking at this going like, man, I could buy 10 calls and make $5,000, or sell 30 put credit spreads and make the same $5,000. Geez, what am I going to do here? For a little extra commissions, I'm putting the odds in my favor a lot more. Okay? Okay, so call credit call credit spread review. Sell a call, buy a call above that for protection. You want the price to stay below the strike price of the call option you sold. And it's okay if it dips below. The main thing is that it ends, kind of hovers around there. And then your max loss, of course, is the difference between the two strikes. So very similar to the other one. Okay, now when you're exiting the trades, it's when you're opening the trade, it's like, okay, I'm going to open the trade, and then when you go to close it, it's you're buying it back. Okay, so to open the trade, you're going to sell it to open, and then you're going to buy it back to close it out. And most platforms are intuitive about this. You right-click on it, you close it, and it'll do it for you. And you can see right here, you right-click, you arrange it so that it shows the spread, and you can create closing order. And again, this is typically very intuitive around most of this. Okay, so quick summary here, and I just was kind of ranting about this a little bit. Remember, if you buy a long call, the stock has to move higher for you to make money. If you buy a long put, the stock has to move lower. However, if you do a vertical spread and the stock doesn't move higher but trades sideways, you can still make the same amount of profit. And if you sell a call credit spread and the stock doesn't actually move lower but it trades sideways, you can still make the same amount of profit. So the vertical spread does give you an edge because there's theta decay moving in your favor. The stock doesn't actually have to do what you think it's going to do. So when I'm buying options, and like I said, I still buy calls and still buy puts, I only do it if I've got a specific setup that has proven itself over time to work. Now, there's an indicator called the TTM squeeze, which is available for free on Thinkorswim, and it's also available for free on Tastyworks. The TTM squeeze is an indicator that I created way back when I had a trading company. It was called Trade the Markets. Eventually, that name changed to Simpler Trading. That seemed to make more sense. But even though I've been using this indicator for over 15 years, it is still my favorite indicator, and probably 95% of my trades are based on some rendition of the squeeze. All the squeeze is, it's a very simple idea. When you see red dots, what that means is that there's a compression in volatility. It's based on Bollinger Bands and Keltner channels and momentum. But when you see red dots, it's typically showing you that you've got a compression of volatility. Okay? And when it's got a compression of volatility, it's building up energy. And it is impossible for a stock to stay in this position. It actually has to release that energy. So the biggest moves, you'll see here, it's like, okay, we're moving, blah, 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 blah. The biggest predictable moves, okay, I'm going to say this again, the biggest predictable moves always happen after a squeeze. So like right here, am I going to buy a call? No, I think it's going to go higher. I'm selling a put credit spread. Right here, there's a squeeze. Could I buy a call? Yes. I'll probably still buy a put credit spread, but I'm also have faith that I've got the opportunity here for a large, rapid move, meaning I've got mathematical precision that a rapid, larger than normal move has a high probability of happening, much higher than at any other time. Okay? Now, does it have, just saying like, oh, it has so many fake signals. Okay, you got to get the rest of the picture though. You got to have a squeeze plus stacked moving averages. If you do not have stacked moving averages, you do not have a setup. Okay? A long setup has to be perfect. It takes a lot of energy to move a stock higher. All that has to happen for a stock to fall is a lack of buyers. So the first part of this is you got to have a squeeze. The second part of this is you want to have what I call stacked moving averages. If I don't have stacked moving averages, I ain't taking the long trade. So what we'll look at here is what does that look like? So again, by itself, the red dots indicate a compression of volatility and then a release of that volatility, all right? So we're getting that big move. When you see this stuff, and we'll talk about the moving averages here in a second, if you get the red dot, that means that energy is building. The green dot means that it's firing, okay? I like to get in before the green dot. I don't know exactly when the green dot's going to happen. Typically, squeezes build up for about 5 to 15 bars. So I typically wait after 5 bars, and if the conditions are right, I start building up a position. Once we do get the green dot, typically the signal will last 8 to 10 bars, meaning on a daily chart it could be 8 to 10 days, but if it's an hourly chart that would just be 8 to 10 hours. Okay, so what's nice about this is you can use it on any time frame. If you're a scalper, you can use it on the 1 minute chart and it would be about an 8 to 10 minute trade. Okay, and then if you're looking at the momentum on this, how this works is that light blue is rising momentum above zero, dark blue is falling momentum above zero, red is falling momentum below zero, and yellow is rising momentum below zero. And I do like it when you have this rising momentum below zero and then you get the squeeze because it kind of turns into a slingshot. And those can be fairly powerful. Okay, so the next thing that I like, because I don't like to use it by itself, as correctly pointed out, if you use it by itself, it's kind of like, well, which way is this going to go? Is this going up? Is this going down? I don't know. So I use the 8, the 21, 34, 55, and 89 period exponential moving averages, which are also free on Thinkorswim. Now, why these? They're just the ones that I was trained on, okay? They are based on Fibonacci sequencing numbers. I don't have them all in there, like I don't have the 13, but 21 plus 34 is 55, 34 plus 55 is 89, etc. If you like the more traditional, like 10, 20, 50, 100 simple, that's okay too, because I'm not necessarily looking specifically at the moving averages in terms of prices. I'm looking at them in terms of the arrangement because they indicate the strength of the trend. And then all you have to do is that when you put them on there, you put them on there and then you just change each one to like because I think the default's like the 21. So change one to the 8, change one to the 34, change one to the 55, and then choose different colors. I like, I'll show you the picture of the ones I like, but choose different colors. If they're all the same color, you don't necessarily know which one is which. So what I like to do is I see that the squeeze histogram is okay. So basically, then what am I going to do to get into a long trade? Because I got to have a couple of things that are happening, and my plan is to get in when this specific series of events takes place. First of all, the squeeze histogram is positive, meaning that it's either yellow and rising, okay, or it's above 0 and it's light blue, which is very powerful. Then I want to see that the moving averages are stacked positive, meaning that 8 is on top of the 21, which is on top of the 34, which is on top of the 55, which is on top of the 89. I call that stacked positive. And then last, price needs to be above the 21. Okay, if the moving averages are stacked positive but price is down at the 89, it's a no-go. If there's a squeeze and the moving averages are crossing all over the place, it's a no-go. It has to be this situation. This situation is a high probability long. Then what I'm looking for is I'm looking for price to pull back to the 21, and that's my kill zone. All right, so if we got 5 red dots and price is pulled back to the 21, boom. Guess what I'm doing? What we've already talked about tonight. I'm buying Delta 70 calls 30, 40, 50 days out. Okay? That's it. I mean, everything we've talked about comes down to this page and knowing what call to buy. Or you could sell an at the money put credit spread. We've talked about that as well. But more importantly, that's the signal that gives you the confidence to do it. Okay? So you can see here, this is what it looks like. Here's a squeeze in Microsoft. The 8's on top of the 21, which is on top of the 34. There's a squeeze. We're at the 21. Great, let's buy some calls. Now you're sitting there. This is why you go 30 days out or more. For like a week and a half, nothing's happening. And if you have long calls, you're losing money, and then boom. All right, that's what we're looking for there. Here is Fizz, makers of that tasty beverage. You got the squeeze, here's the moving averages, you come down to the 21. In this case, it takes off right away, and it's fantastic. Same thing here. Now, you can't, this is a little trickier. If you get a situation where you get a downtrend and then the 8 crosses the 21 and there's a squeeze, I like those, but to be frank, that's a little bit more difficult. It's a little sloppier. It's easier, and if you're newer starting off, look for the times when they're all clean and stacked positive, okay? This was a trade that we did earlier in the year. It was a lot of fun. Here's the squeeze, moving averages are stacked, we buy, boom. Here's the squeeze, moving averages are stacked, we buy, boom. All right? And then this is space. We did a trade here in Virgin Galactic, which was a lot of fun. This is a long squeeze. It was brutal. But then finally we got the moving averages and boom. This is what I would call a fairly textbook squeeze because it's so clean. So you had a nice run up, and then look at this, we're quieting down, catching our breath. Look at the squeeze. The momentum's staying above 0. It's falling down, but it turns. Price stays above the 21. The moving averages are clearly stacked positive. We come down to the 21. That's your moment in time. Boom, boom. So what you're going to see with this is that there's a lot of patience. Once you realize that you're trading a setup, you're trading a specific set of circumstances that are coming together and not a stock, then you learn to wait for the setup. And I mean, honestly, trading is a lot of waiting. You're waiting for the stuff to set up. Don't chase. Don't, just wait. Because when everything comes together, that's when you can strike and make a killing. So when a lot of people are, like getting frustrated and getting stopped out, and you're just patient, you only need 1 or 2 good trades a week, and you're good to go. Okay, so what about, where do you get out? Good question. So what expiration for the spread? So if I'm buying a call off a daily chart, so let's say I'm buying a call 45 days out, I am fine selling a vertical around 15 days out. So I'm fine going shorter on the spread simply because we want that fast theta decay. Does that make sense? But I'm going out longer on the calls because we don't want that theta decay. So I like to, so a lot of times what I'll do is I might say something like, wow, I like this. I'm going to buy 10 calls that are delta 70, and then I'll sell, maybe 30 verticals that are at the money. And that's a great combination because, the premium decay here that you're collecting often offsets any decay there while you're waiting for it to move. And it makes it, frankly, easier to hold on to. So in terms of targets, I do look at predetermined overhead targets, whether it's overhead resistance. I'm a big fan of Fibonacci extensions, different things like that. So I do like to scale out as it starts to move my way. And then in terms of a trailing stop, if we do hit that 34 period moving average, I'll get out of the rest. Or if the 8 crosses the 21, I'll get out of the rest. Or if we get 2 dark blue bars on here. So example this, this might be the 1272 extension if you guys are familiar with fib extensions. But then as it starts to lose momentum here, the squeeze is over at that point. So you just get out of the rest of it. And you can get out before then, but at that point it's over. Like it's no longer a valid setup. Okay, we've been looking at long setups. Here's an example of a short setup. It's hard to see it. There's black dots there. You can see it fired to the downside. There's the 21 and puke. Those are fun. They typically happen fairly quickly. Here's an example of Roku where you got a nice little squeeze, and boom, you pop off of there. And that's what I like, are those kind of quick pops. Some examples just with underlying stocks, because that's what we're trading, right? So here was a squeeze on Google, bought shares of stock, all right? What's nice about that is that if you're trading the option, it's a lot cheaper than buying the shares of stock. But just to show you how powerful it is, this was on Shopify. Here's a squeeze on a 5-minute chart, boom, it moves fairly quickly. So you could do it on the stock too. You don't have to trade the options, but the options, of course, are nice. Now, here's an example from one of the biggest trades that I did this year. And here's a textbook example of a 30-minute squeeze. The moving averages are all stacked positive. This is in Tesla. Beautiful momentum. And, I was at this point, my account, it was pretty sizable back in August. I mean, this has been a phenomenal year. And so, I bought 1,000 shares of stock at 16.44 just to market. But what I did is I bought in the money calls, and then a strategy we didn't really talk about is I bought some out of the money calls to offset it, and that's just called a call debit spread instead of a call credit spread. And in this case, it turned into a $2 million trade, which was pretty amazing. I mean, I've been doing this a long time, but anytime I can make a $2 million trade, I'm happy. That certainly does not happen all the time, but in this case, I had the confidence to put on big size because it was such a textbook setup.